Hey guys, it's Jamin Kirkwood with Secure Financial Management. I want to send you a quick video about something we've been addressing with clients lately, and it's about something that could be lurking in your investment accounts, whether it's voluntary investments you've just been contributing to and it's a problem with the allocation, or it could be something inside of your 401k that you're not aware of, and that is around what's happening with interest rates, in particularly bond fund positions that you might be holding. So to back up a little bit, you're probably aware that when we talk about an allocation, a target allocation, a lot of the times it breaks down to, well, we'll put a certain amount to stocks, a certain amount to bonds, and the way bonds are positioned and identified is, hey, they're the safe haven. That's the stuff we can always come back to. It's more about protected side to hedge against the stock market, and in general, that's true, okay? But what that has also created is an environment where people think that there is no possible loss on the bond side of things. And for some time, if we go back about 30 years, in general, that's been true. But you can lose money in bond funds, and it's something that you should be aware of. Now, obviously, in this sort of environment, I'm not going to give you specifically tailored advice as to how you should allocate your portfolio, but I want to more educate you on how bonds work and something you should be aware of. And if you go back and look at any bond allocations that you have, again, whether they're in 401ks or just private investments that you hold, you're probably going to find that you've had some losses this year. And if you discover that, it might be a bit of a shock. But it can happen, and it's happening right now. But why does this happen, right? Generally, as investors, we think, well, interest rates are going up. That's great. We're going to get more return for our money. And for some things, that's true. But bonds have a little bit of a strange relationship with interest rates. And why this hasn't really been an issue in general, almost for the past 30 years, is because if we go back to, let's just say, the early to mid 80s, if you look at interest rates from the early to mid 80s till now, it hasn't been a straight line down, but it's been a pretty general progression down. And in that environment, in a decreasing interest rate environment, it's pretty easy to make money in bonds because as interest rates go down, bond values go up. As you're probably aware, we're in a very low interest rate environment. We have been. It's starting to change, right? We're starting to enter more of an increasing interest rate environment. And when that happens, you can and very likely will lose money in the bond side of your portfolio. But let's go into a little bit of detail of why. How does this work? Well, bonds are typically issued in $1,000 increments. I've got my bond here. I've got my Kirkwood bond, right? This Kirkwood bond is a $1,000 bond, like most bonds are issued in $1,000 increments. It's yielding 2%, and it's a 10-year bond, right? Now, there's lots of different factors that can affect the value and the quality of a bond, but let's not worry about all those different aspects. It can be the duration, it can be the credit quality, it can be things like that. But let's just focus right now on the interest rate side of it, right? So I have my $1,000 bond yielding 2% for 10 years. That's great. But what happens now is that interest rates have gone up, right? Interest rates have moved from 2% to 3%. I don't want this bond anymore. It's only paying me 2%. So I want to get rid of it. I'm going to try and sell it. Kevin, I want to sell you this bond. Will you buy it for $1,000?
Why would I buy your bond at 2% when my unicorn Kirkwood bond is paying me 3%? Psh.
You know what? Kevin's actually right. Why would he want to buy my bond that's only yielding 2% when he can get a new bond that's yielding 3%? So I'm stuck with this bond now yielding 2%, but I don't want it anymore. I want to sell it. I want to get rid of it. How am I going to get rid of it? I've got to discount it. I've got to sell it for less than what I paid for. I can't sell it for $1,000. I'm going to have to sell it for, in this case, let's say $900. I'm going to lose money. I'm going to lose value on my bond because interest rates have gone up. And that's what's happening in general with a lot of your investments that are in bond funds or bond type vehicles, is that they are losing value because the actual cash value of that bond, if it has to be sold, isn't $1,000. It's less because interest rates have gone up. It's some important information that I wanted to get out to you. Again, this is a more complicated topic than what I'm explaining right here. If you'd like to take a review of your accounts, and see what sort of bond exposure that you have and maybe some ways to mitigate that risk, let us know here at the office and we'd be happy to set up a time to meet with you. The information is right below on this video. Again, none of this advice should be considered an investment recommendation or investment allocation. If you'd like to talk about that in more detail, we'd be happy to learn about your situation and help you out with some recommendations. See you next time.